Thank you for listening to Overleveraged, where we explore the big macro themes affecting investors, economic imbalances, giant geopolitical trends, tail risks and tremors, and everywhere risks are not being fully priced into markets. Remember, trading carries risk, and all opinions are provided as general market commentary only. Please do your own research. Our risk warning will follow at the end. April 1997, and just as the John Major government was in its throes, a seemingly innocuous academic paper was presented to the Institute of Actuaries. Paper like these seldom cause a ripple, but this one, called The Financial Theory of Defined Benefit Schemes, was to produce shockwaves. Controversially, this paper argued that pension liabilities were like bonds, which meant they should be hedged against market rates. This small accounting change had profound effects on the UK's financial markets and created a monster that would many years later cause turmoil in the giant government bond market and lead to profound changes in the UK equity markets. So that's all about LDI and changes to pension schemes, which we're going to discuss, and whether or not that is actually why the UK market is doing as badly as it is, certainly on some measures. So joining me today on Overleveraged is John Human, who is head of content at Vox Markets, former editor of Investors Chronicle, and all-round expert really on the UK stock market and the UK sort of equity space in general. Thanks for joining us.
Thank you for having me.
I hope that's not too big an intro. Yeah. So I've bigged you up, but so I guess we want to discuss why the UK market's not really punching above its weight, or indeed punching at its weight at all. Lately, earnings multiples suffered. It's shrunk. I've got lots of stats which we can go into. But do you think that LDI stuff is a factor?
You would think it was one of many factors, for sure. It just became less attractive to invest in UK equities at that point in time. And I think it's true. The ripples have been felt ever since. I know the stats that you point to in terms of sort of de-equitisation, the amount of companies listed on the London markets is going down, and over the past few months, it's something I look at regularly. Certainly in the smaller end of the market, at a rate of knots. We've seen more companies disappear every week.
Yeah, so I've got stats from Lapthorn. Just 319 UK stocks with a 6-month average daily trading volume is $1 million or more. Over 860 in Europe, 1,400 in Japan. The US is over 3,000. So the UK market has shrunk a lot. It's now accounting for just 3.5% of the MSCI All Country Index. It used to be 8.5%. Charles Hall at Peel Hunt, he's head of research there. He calls it a doom loop where valuations are low, liquidity is reducing, investors are seeing withdrawals, and there's little desire to IPO. If this continues, he says, the UK could lose a crucial part of its financial ecosystem. So things are looking pretty grim.
Yeah, grim. But the question is whether it's an idea. I think doom loop is fairly appropriate.
Yeah.
Because without liquidity, there is no attraction. If you buy a share one day and even if the price hasn't moved, you've got to sell it for the next because the spread will kill you. That's what happens here. And so that's obviously particularly true at the smaller end of the market. But the smaller end of the market is where you would generally see the majority of flotations of IPOs. And where's the attraction in coming to a market where no one's going to trade your shares? It's tough out there.
And smaller companies are shunning public markets, and that could be a chicken and egg kind of situation, but nevertheless it's happening.
Yeah, it's happening. And one of the things that we're seeing a lot is companies. I mean, arguably, is it a bad thing for the economy as a whole, or does it really matter? Is it just a market problem, therefore we don't need to worry about it if we're thinking about the broader economy? Because a lot of companies, rather than choosing to come to market, can raise money elsewhere. They can raise it privately. Private capital is huge now, absolutely huge and growing, and they're sitting on dry powder, like you wouldn't believe. So the growth of private equity has mirrored this decline in public markets. And therefore, if you want to access the companies that you can't access on the markets, you access that through private equity, some of which is listed. So, there is a certain irony to that. So it's tricky to see, how this can be overcome. One of the, obvious difficulties companies face in coming to market is that it's expensive. Yeah. It's really expensive. You have to hire a lot of advisors. You have to pay your annual listing fees to the London Stock Exchange, wherever it might be. And yeah, it's just simply an unjustifiable cost for many smaller companies if it doesn't deliver trading liquidity. And so then you wonder about what is the purpose of the stock market. It should be to allow companies to raise the capital they need to grow. But if they can get that elsewhere, then why bother with the hassle?
Yeah, I think it's easy to put the cart before the horse and just look at the stock market as a means of speculation.
Well, I think that's what it's sort of become a little bit, to be honest.
Yeah, it's not a means to raise capital and financing for growth companies, and this is a problem because I think we do have growth companies, we do have tech stocks, we just don't have them in the stock market. So the UK is 5% tech, Germany's 11%, US about a third. So maybe we do have the smaller companies, but they're not coming to the market. They're not getting on the stock market.
And when they do get onto the market, they struggle to attract investor attention. I mean, I think sort of just going back to those global figures about the proportion of UK equities in the MSCI world. All of those figures have been skewed by the rise of big tech.
Yes.
It just accounts for such a huge proportion of the US market and therefore the global market that everything looks pale in comparison.
Yeah, I mean, you see these charts often in the newspapers and so on. There has been a shift since Brexit, but that ties in with other stuff as well. 2016 UK and global equities trading about 18.6 times earnings. Since then, UK's down to about 10. US world to more like 20. So there has been a big divergence. Lots of people will say Brexit is a factor. It could well be. Certainly some of the government policy, maybe not Brexit, but the government uncertain policy making process of the last few years has certainly been a factor. But it's not all stock markets have grown. So China is now trading 8 times.
Yeah, and that's a different story altogether. Horror show.
And actually, there has been the US has outperformed massively. Massive skew from the US and big tech. So it's not just a UK problem, but it's maybe just worse in the UK than elsewhere.
It does feel that way. I mean, we're a notoriously gloomy bunch in the UK anyway, and I think that applies to our markets as much as anything else.
I think I've got something written in here about is it just inherent conservatism, I think is what I put down, which is maybe a more optimistic way of putting it. But gloomy bunch.
We are a gloomy bunch. We are a gloomy bunch for some strange reason. But the UK is what it's. China aside, you look at it comparative to world markets, it's the cheapest of the lot. Now, you could argue that actually, that's not just a factor of the fact that small companies either choose not to come to market or once they get there, struggle to gain traction. But that we are, the FTSE 100 is still a
Jurassic Park.
It's Jurassic Park. That's a very good description. Of it. And,
it's not my description; that's somebody else's. But it's a good one. I mean, it is a good one.
I've not heard it before.
Yeah.
But those large companies, I think sclerotic is perhaps the word to use to describe.
See, we used to use that word for France. 10 years ago, and not anymore. Well, maybe some people do.
But big oil, banks, banks are not exactly forward-thinking, really. If they are forward-thinking, it's because fintech has come along sort of up the rail to give them a bit of a scare. But big oil, really should be. You might disagree with this, Neil, but sort of driving
change,
and driving investment in new forms, and they just haven't. They just don't put their capital to good use. In fact, one of the arguments against the UK market is that we have this obsessive focus on dividends, and companies' dividends are what matters. They are sacrosanct, and actually they have delivered a big chunk of total returns. Certainly on the FTSE 100, but also that means that those dividends, that money that's distributed as dividends, is not being reinvested in opportunities, in things that could drive growth.
Yeah, and that's something that actually marks out the Magnificent Seven in the US. So these are the 7 big stocks: your Microsoft, Amazon, Apple, Tesla, Nvidia, Microsoft. Might have said that already. And the other one, the 7 of them. Forget Chico. They invest something like 60% of their free cash, which is, I think, 3 times what the rest of the S&P 500 does. and it's a lot more than the tech bubble 5 back in '99, and it's a heck of a lot more than anyone in the UK is doing. So that reinvestment, that long-term outlook is key. And that's why I think we want to come back to this LDI story again. But
the LDI did relate to dividends. But so in that sense, arguably, it should have encouraged companies to invest more in growth initiatives. But it just hasn't. Like I said, I just find these very large industries to be very, very lacking in imagination. That I think is one of the reasons why attitudes to the UK are what they are. So it's from an investment perspective. There are some really fantastically innovative companies on the market. Relex is one that would spring to mind. I would argue that is the UK's biggest tech company.
Not Ocado. I think I've discussed Ocado with you before many years ago.
Don't get me started on Ocado. This obsession with, as I say, maintaining a dividend. I mean, Shell cut their dividend a few years ago, and it's
uproar.
The amount of headlines about that.
Yeah.
But
I think that was oil had gone negative though or something.
The oil price had gone negative. So
fair days.
But this is a big headwind. It's strange because in some sense it's an attraction of the UK market, but in others it's a reason not to invest in the UK.
It holds it back, right?
Exactly.
Yeah. So this is I'm going to harp on about this LDI thing once more. So Sir John Kay, I think we've probably read as a top economist.
Yeah.
He says it's one of the great avoidable catastrophes of British public policy because basically since then there's a IFRS 17 and IAS 19 accounting changes which put pension deficits onto corporate balance sheets back in 2000.
Yeah.
It was a long time ago, but it all comes back to this financial theory of defined benefit schemes paper. And since then, UK pension funds and the like have reduced their holdings of UK equities from about the figures I've seen vary, but around half, say 50% to 44%, down to 4%. So they've just simply not invested. They've been a persistent seller, if you like, of UK stocks. At the same time, the holdings of gilts rose to 72% from 17%. So they've completely inverted their structures, and that has had a long-term impact.
But it's obviously matching liabilities. Basically, they have to match their liabilities.
Well, it's a policy.
As a
policy, but that's why it's a policy change that could be changed again.
Yeah, I mean, but arguably though, if UK pension funds have been, essentially net sellers of UK equities, that doesn't mean that other nations have to be net sellers of UK equities.
No,
because there's better opportunities elsewhere. Like we've talked about. I mean, so I think you mentioned the figure at the beginning. It's 300 and odd companies that
319. With a decent with a trading volume of $1 million or more,
with decent liquidity.
Yeah.
So
that's not many, is it?
It's not many at all. There are not many companies out there that, if you're sitting in an office in New York, are you going to be fishing at the bottom end of 8 because the liquidity is not there, the scale isn't there. They're just. I mean, this is an extraordinary thing. I once, for a piece I was writing for the Investors Chronicle, looked at the British engineering and electronical engineering and defence sector and aerospace sectors all combined, and the combined market valuation of all of those sectors in aggregate in the UK is smaller than Siemens.
The Siemens,
yeah.
So that's even more. I mean, I've got this at the top of my notes. The $2.9 trillion cap of Apple is market cap. So Apple is way more than the entire UK market.
Precisely. So the opportunities just aren't there, and so if you want to change the trajectory of the UK market, then there surely has to be greater support for the growth end of the market. You want those small companies to get bigger, so that they attract overseas capital. So actually what happens is, at the moment as well is, when a company at the smaller end of the market enjoys some success and starts to grow, it doesn't stay on the market for very long at all.
No.
A foreign buyer will come and snap it up. We do have a habit of letting our good tech go. And go look at AI. One of the leading companies in AI is DeepMind. It's a British company, but that fell to Google eons ago.
Yes, ARM as well.
Yeah.
So there's some great companies out there, just haven't been able to access the depth of liquidity and capital markets.
Yeah.
So I guess that leads us neatly on to what can be done. Because there's lots of chat that I've got, Mansion House, Edinburgh, Canada model. These are ideas. So Mansion House and Edinburgh sort of schemes have been talked about to reinvigorate equity markets. Do you think they can?
I looked
do anything?
I looked at the Edinburgh reforms, and I didn't see much that really.
It's tinkering.
Woke me up to the this is it. This is the one that's going to change it. When as you say, there've been various proposals and how to improve the attractiveness of the UK market before. There were proposals recently to kind of make it easier for companies to float whilst retaining sort of some kind of differentiated share structure. So
you end up with Deliveroo,
and you end up with the Hut Group and Deliveroo, and arguably neither of which are really sort of tech companies.
No, well, newspaper owner.
Indeed. So I think it is bottom up stuff. It's really bottom up stuff, and it is supporting growth markets. I mean, you still have to pay. Well, AIM you don't have. But there are sort of attractions to investing in AIM, stamp. Right. There are benefits as a taxpayer. But we've reduced the lifetime allowance on pensions. We do everything in our power to make it unattractive to invest, and at the same time, all we seem to want to do as a government. I'm getting very gloomy myself here. Getting very British, and this is the other British obsession: housing.
But then there's not that much of a difference if you look at the US. I mean, we might vary from say Germany, where you might buy a flat with cash with your €500 notes, but that is true that we are focused on housing and we don't have money for anything else as a result. But is that really that different from the US? So?
I don't know. I mean, in the US, people have a much more hands-on approach to their pension savings, their retirement. The 401k.
401k that you always hear about.
Yeah. So there are. You could manage your own pension in this country through a self-invested.
It's quite complicated. Though. I mean, I look at mine and I think. And I look at the platform. I look at I'm not going to say which one, but it's good. It's easy to transact, but it's not easy to know what the hell you're supposed to do.
No.
Well, should I have this amount in this and this amount in that? And if I sell that, is that going to incur some stamp or some tax implications down the line? It's all. And I'm, fairly well versed in this stuff, and it's complicated.
It is complicated. I find it very complicated, and I've been looking at this stuff for decades.
Yeah.
But I think when I say bottom up, I actually think and this goes back to exactly what you just said. Investment is poorly understood. Money is poorly understood.
Yeah.
Running businesses is poorly understood because everything we are taught in schools is sort of certainly from a sort of mathematical perspective is almost entirely abstract. And actually. The tangible thing is a house. So this is what people aspire to own.
Yeah.
And so I really do think there is a back to basics education thing, and it's going to take decades to work its way through the system.
I'm beyond hope.
I
agree. Yeah.
And that's what I think it takes. I think financial education and proper financial education from a young age is notably absent in this country. The other thing I would say about the UK market is is this the point of maximum pessimism? Are we just writing off the UK as a Scrooge market because it's fallen out of favour?
So this is a question that I've got written down on the notes, which is it cheap for good reason or is it genuinely cheap? Is it good value, I guess?
I mean, I've spoken to a lot of UK fund managers, UK investment trust managers recently, and their view is that we are in the middle of there's been a huge overreaction to some political events like Brexit and such the like, and that there are fantastic opportunities as investors in the UK market.
Yeah.
There's, I looked into this. There's some of the overreaction hypothesis. We've overreacted negatively to dramatic events. Arguing the same way that in the US they've overreacted positively to sort of
well, they're more optimistic than we are.
But the underperformance we've seen could actually lead to outperformance in the years ahead. You can have a mean reversion effect at work, adventurous investors, contrarians. Like one guy said to me, "Go where the car crash is." Because you're not going to find value where everything looks happy and glorious.
No.
And things in the UK don't look happy and glorious. Maybe that's where the opportunity lies.
Well, on that note, happy and glorious. I think that's a great way to end. A great way to end to talk about the UK equity market. So thank you, John. As ever on Overleveraged. Yeah, thank you very much for your insights, and we'll be back next time on Overleveraged. So do follow us and join us and subscribe. Thanks for listening. Remember, all opinions, news, research, analysis, prices, or other information is provided as general market commentary and not as investment advice, and all potential results discussed are not guaranteed to be achieved. The information may have been derived from publicly available sources, company reports, personal research, or surveys. Past performance is not indicative of future performance. Trading carries risk of capital loss, and the service is available to professional clients only.